Right now, pretty much everyone you talk to is pointing fingers at the Middle East when it comes to inflation. It's the dominant narrative out there, and honestly, it makes total sense why so many people have accepted it. I mean, it's super easy to follow. You've got a clean cause, a clean effect. It's so simple you could literally map it out on a napkin. But there is a massive hidden flaw in that logic. In today's explainer, we're going to break down exactly what that flaw is, so let's dive right in.
Here is exactly where that mainstream narrative just completely falls apart. You know the recent conflicts dominating all the headlines? That's a 5-month-old story. But the Federal Reserve doesn't actually use those headline numbers to measure our economy. They are looking at a 5-year-old problem. Specifically, their very own internal inflation measure has missed its target for 63 months in a row. Guys, that is more than 5 straight years. We are diagnosing a deeply entrenched 5-year structural issue using a 5-month-old news cycle.
So, what is this real scoreboard the Fed uses? It's called Personal Consumption Expenditures, or PCE for short. And right now, it's sitting at a little over 4%, which is more than double their 2% target. Now, you might be wondering, why does this actually matter to me? Well, because this single number lies at the absolute foundation of every single economic decision in the United States. Every rate you pay is priced off what people expect this specific number to be. We're talking your mortgage, your car loan, what your savings account pays you, even what the actual cash in your wallet is going to be worth next year.
Section 1. The 2% target. Why 2%? For a number that the entire global financial system is anchored to, you'd probably assume it fell out of some impossibly complex math equation, right? Or maybe it was carved in stone by legendary historical economists. But actually, no. Somebody just kind of chose it. As Christopher Neely from the St. Louis Fed explains, it was simply a trade-off. Central banks weighed the costs of having inflation against the benefits of having just a little upward price movement to stabilize the macroeconomy. So 2% was essentially just chosen as a happy medium.
And this brilliantly illustrates why they couldn't just pick 0 or go with something higher. It's all about finding that Goldilocks zone. If you target 0%, sure, on paper it sounds amazing. But when a recession hits, the Fed cuts rates to stimulate the economy. If inflation is already at 0, well, rates are already near the floor. They'd get maybe 1 or 2 cuts in before slamming right into 0, leaving them structurally trapped with literally no road left, risking a decade-long depression. But what if you push it to 4%? Well, prices would double every 18 years. Businesses couldn't forecast their costs, making long-term planning basically impossible. So 2% gives the economy a nice little cushion without you really noticing it on an ordinary Tuesday.
Section 2. The Volcker Playbook. How we survived 13.5% inflation.
To really understand the crazy tightrope the Fed is walking today, we've got to look back at the late 70s. Inflation was sprinting. The dollar in your pocket was practically rotting while you held it. Enter Paul Volcker in 1979. He did what absolutely nobody else had the stomach for. He drove interest rates all the way up to 20%. He deliberately triggered 2 back-to-back recessions just to strangle the money supply. And this incredibly aggressive move, which came to be known as the Volcker shock, it actually worked. He successfully dropped inflation by over 10 points, eventually bottoming it out under 2% and kicking off an era of steady growth known as the Great Moderation. So, here's the big question for us today. If that aggressive playbook worked so well for Volcker, why on earth can't the Fed just run it again right now?
Section 3. The National Debt Trap. Why Volcker's playbook won't work today.
Okay, so here's the massive hidden advantage Volcker had that nobody really talks about, but it's right there in the historical data. Back in 1980, the national debt was only about a quarter the size of the whole economy, around 25% of GDP. By today's standards, that is practically nothing. So when Volcker slammed on the brakes by raising rates, it acted purely as a brake. Today, our debt-to-GDP ratio is sitting around 100%, which is a post-World War II high. In this kind of environment, raising rates acts as both a brake and a gas pedal at the exact same time.
Let's break down exactly how this trap works. Step 1. The Fed raises rates to cool the economy down. That's the brake. But because our national debt is just so impossibly massive, Step 2 kicks in. The government now has to pay significantly more interest on what it already owes. And Step 3, those massive interest payments don't just magically vanish into the ether. They land directly in the hands of pension funds, banks, and wealthy investors, quietly pumping trillions of dollars right back into the economy. That is the gas pedal. And the heavier the national debt gets, the harder that second foot pushes down on the gas.
What's wild is that 2 economists actually saw this exact danger coming decades ago. In 1981, Thomas Sargent and Neil Wallace published this highly influential paper, warning that if the government never runs a surplus, the central bank literally can't make the debt smaller. They just postpone the inflation. The Fed ends up squeezing the cash side, which forces the bond side to grow, endlessly compounding the debt. And guess what? Thomas Sargent, the co-author of that very paper, has just been asked by the new Fed chair to lead a task force tackling our current structural inflation issues. Talk about coming full circle.
Section 4. The money supply problem. Earthquakes, fault lines, and M2.
Now, you might see headlines saying inflation is cooling just because gas got a little cheaper last month. But remember, the ground is always the very last thing to shake. By the time you actually feel an earthquake, the fault line slipped a while ago. Things like housing lock in rents for an entire year, so those numbers just represent pressure that was released months ago. To get to the real truth, you have to realize that prices only go up if someone actually has more money to pay with. Money moves first, always. And the best measure for that is M2, which is basically all the cash within arm's reach of the economy.
And right now, that M2 money supply is growing at over 5.5% a year. That is the fastest pace we've seen since July of 2022. But here's the kicker. Money doesn't just reappear on its own out of thin air. Somebody has to be putting it there.
So, if inflation is public enemy number one, who is quietly pumping fresh dollars into the system? Well, it's the Federal Reserve. They have this hidden lever, a literal money printer used in emergencies called quantitative easing, where they basically print money to buy bonds. During the 2020 pandemic, they ran this printer harder than ever before in human history, pushing their balance sheet to nearly $9 trillion and spiking inflation over 9%. To fight that off, they had to run the printer in reverse, a process called quantitative tightening, letting bonds expire to drain that excess money out of the system.
It's absolutely crucial to look at the timeline of events here. In June of 2022, they started quantitative tightening, eventually taking more than $2.2 trillion off the balance sheet. And you know what? It actually worked, shrinking the money supply for the first time since the Great Depression. But you can't just drain the system forever without breaking something. So on December 1st of last year, the Fed announced QT was officially over. And incredibly, just 11 days later, on December 12th, they turned the engine right back on, buying around $40 billion in bonds a month, refilling the very balance sheet they just spent 3.5 years painstakingly draining.
Section 5. Fixing the deficit. The real numbers behind the structural problem.
We really have to look past all that monthly headline noise and look at what is running underneath the entire U.S. economy. The Congressional Budget Office now estimates the deficit for this fiscal year alone will reach a staggering $1.4 trillion. That is 5.8% of the entire economy, sitting far, far above the previous 50-year average of 3.8%. Guys, this isn't just an expensive couple of years. This is a deeply ingrained structural overspending issue.
Get this. Back in 2021, interest payments ate up about 9 cents out of every federal dollar collected. Fast forward to this year, it is devouring 19% of all federal revenue. It is literally more than doubled in just 5 short years.
To put that into perspective, because I know these numbers get so huge they lose meaning, net interest on the national debt is now over $1 trillion a year. That makes it the third largest line item in the entire federal budget. We literally spend more just on the interest of our debt than we do on the entire U.S. military. The debt snowball that those economists warned about back in the 80s, it is playing out exactly as they predicted.
So, how on earth do we fix it? Well, Warren Buffett actually proposed a radically simple solution to this uniquely American bipartisan problem. He said, just pass a law that any time there's a deficit of more than 3% of GDP, all sitting members of Congress become completely ineligible for re-election. He chuckled when he said it, but he is completely right about the core issue here. It is an incentives problem. Absolutely no one builds a successful political career by promising people less, so the incentives always point towards spending more.
Which leaves us trapped in this vicious compounding cycle. We borrow more money, which means we owe more interest, which means we have to borrow even more just to pay that new interest. It is a never-ending, repeating loop that is completely unsustainable for the long term. And every single year we put this off, the bill to finally deal with it just gets larger and heavier.
Which brings us to a final thought for you to consider as we wrap up this explainer. Look at the facts we've just walked through today. Is this compounding debt and structural inflation a massive crisis we absolutely must face right now, or is it just cyclical noise that will somehow resolve itself? The math pretty clearly tells us that this path doesn't fix itself. Something eventually has to change. So, how do you think